Have you ever wondered why the market always reverses at certain price levels? That's not by accident. It's the power of supply and demand. In this video, I'll show you a step-by-step trading strategy that smart money and banks use, and how you can apply it to your own trades. Welcome to our deep dive into supply and demand trading. Before we get into advanced strategies, we must master the core principle that drives every market movement. What truly makes prices go up or down? It's not random noise or complex indicators working in isolation. At its heart, the market is fueled by one simple, powerful force: the constant battle between supply and demand. Understanding this concept is like learning the fundamental language of the financial markets. It allows you to see beyond the candles on your screen and understand the real story of where institutional or smart money is making its moves. So let's break it down, starting with supply. A supply zone is a specific price area on a chart where an overwhelming amount of selling pressure previously entered the market, causing the price to drop suddenly and forcefully. But why does this zone hold significance later? Imagine a large hedge fund needs to sell a massive position. They can't just dump it all at once, as that would crash the price and result in a poor execution. Instead, their initial selling creates a period of consolidation or a small base. The key is the sharp, imbalanced move away from this base. This powerful drop signifies that there were far more sellers than buyers, and crucially, it leaves behind a footprint of unfilled institutional sell orders. When the price eventually returns to this supply zone, those leftover orders are triggered, creating a fresh wave of selling pressure and pushing the price down again. Now, let's look at the other side of the coin: demand. A demand zone is the mirror opposite. It's a price area where buying pressure completely overwhelms selling pressure, causing the price to rally aggressively. The logic is identical, just in reverse. An institution wants to accumulate a large position without sending the price skyrocketing against them. They build their position within a consolidation area, and then, once they're ready, the price explodes upwards. This explosive move is the evidence of a massive buying imbalance. Just like with supply, this leaves behind a trail of unfilled buy orders. When the price later retraces back down into this demand zone, those pending orders get filled, absorbing selling pressure, and often launching the price on its next leg up. These zones represent areas of significant value where buyers are waiting to re-enter the market with force. To make this crystal clear, think of a real-world marketplace. Imagine the launch of a highly anticipated new smartphone. Supply is limited, but demand is enormous. What happens to the price? It's high, and resellers can charge a premium. That's a demand imbalance. Now picture that same phone model 2 years later. Shelves are full of it, but a new version is out, so demand is low. Stores put it on clearance to get rid of it. That's a supply imbalance. Financial assets are no different. Supply and demand zones are the footprints left by these major imbalances. By learning to spot them, you're not just trading patterns. You're identifying high-probability areas where the market has revealed its intentions, giving you a powerful strategic edge. To find a valid supply or demand zone, look for a sharp move away from a level. If the market consolidates and then shoots upward, that's a demand zone. If it consolidates and then drops sharply, that's a supply zone. The key is strong momentum leaving the area. Don't trade every zone you see. Always confirm with market structure. If the trend is making higher highs and higher lows, focus on demand zones. If the trend is making lower highs and lower lows, focus on supply zones. This keeps you trading with the trend, not against it. Alright, let's break down the heart of this strategy. This isn't about guesswork, it's a systematic, repeatable entry process. Following these steps with discipline is what separates consistently profitable traders from those who rely on luck. This framework is your trading blueprint, designed to keep you objective and focused. Here's the exact entry process. First, you must identify a strong supply or demand zone on a higher time frame, like the 4-hour or daily chart. What makes a zone strong? We're looking for a sharp, explosive move away from a level. This indicates a massive imbalance between buyers and sellers, where institutions likely place large orders. These higher time frame zones carry more weight because they represent a more significant market consensus, making them far more reliable than zones on smaller charts. We also prioritize fresh zones, areas where the price has not returned since the initial explosive move. An untested zone has a higher probability of holding a significant number of unfilled orders, giving us a higher probability trade setup. Step 2 is the hardest part for many traders. You must wait for the price to come back to that zone. This requires immense patience. A common mistake is to be impatient and place a limit order right at the edge of the zone, hoping for a perfect entry. This is an aggressive, low-probability approach. Instead, we act like a sniper, not a machine gunner. We've identified our point of interest. Now we patiently stalk our prey, waiting for the market to show its hand. The way price returns to the zone is also a clue. Does it race back aggressively, or does it slow down and show hesitation? This price action gives us valuable information before we even consider an entry. Once the price is in our zone, we execute step 3. Drop to a lower time frame, like the 5 or 15-minute chart, to look for confirmation. This is our magnifying glass. It allows us to see the battle between buyers and sellers up close and find a precise entry. We are looking for clear evidence that the larger time frame zone is holding. For example, a rejection candle with a long wick poking into our zone shows that price tried to push through, but was forcefully rejected. Or you could wait for a classic engulfing pattern, where a strong candle in our desired direction completely swallows the previous candle, signaling a decisive shift in power. For a more advanced confirmation, you can look for a lower time frame change of character. If the price was trending down into our demand zone, we'd wait for it to break the most recent short-term high. This confirms the momentum is shifting in our favor. Never enter while a confirmation candle is still forming. Always wait for it to close. Finally, step 4 is execution and risk management. Once your confirmation signal has printed and closed, you enter the trade. You must place your stop loss just beyond the zone to protect yourself. If the price breaks through the entire zone, our trading idea is invalidated, and we want to be out of the trade with a minimal, predefined loss. It's wise to add a small buffer to your stop loss, a few pips beyond the zone's edge, to avoid being taken out by spread widening or stop hunts. This disciplined approach, combining a high probability zone with a confirmed entry, allows for a very tight stop loss. This, in turn, gives you an exceptional risk-to-reward ratio, which is the ultimate key to long-term profitability in trading. All right, let's put all this theory into practice. To really solidify your understanding, I'm going to walk you through a classic, high-probability trade setup from start to finish. We'll break down every single step, from identifying the zone to managing the trade. Let's imagine we're looking at the EUR/USD pair on the 4-hour chart. We start on this higher time frame because it gives us a bird's-eye view of the market structure and helps us identify the most significant levels where big institutions are likely placing their orders. As we scan the chart, we notice a period of brief consolidation followed by an explosive, powerful rally to the upside. This explosive departure is critical. It's a giant footprint left by institutional buyers, signaling a massive imbalance where demand overwhelms supply. The origin of that powerful move, that small base of consolidation right before the launch, is what we identify and mark as our 4-hour demand zone. This is now a key area of interest for us. Now, what makes this a high-quality zone worth watching? First, the strength of the move away is exceptional. The candles are large, impulsive, and show very little opposition. Second, this is a fresh zone, meaning price has not returned to test it since its creation. Fresh zones are far more potent because the unfilled buy orders that created the initial imbalance are likely still sitting there, waiting to be filled. So, we've marked our zone. What's next? We wait. This is where discipline separates professional traders from amateurs. We don't chase the price. We act like a sniper, patiently waiting for the target to come to our predefined location. After a few hours, or even a couple of days, we see the price begin its journey back down, approaching our 4-hour demand zone. As the price enters the upper edge of our zone, it's time to shift our perspective. We drill down to a lower time frame like the 15-minute chart. Remember the rule. The higher time frame tells us to look for a trade, but the lower time frame tells us to execute it. We are now hunting for a specific confirmation signal. We need evidence that the buyers who showed up here before are stepping in again. A common mistake is to blindly place a buy order the second price touches the zone. This is gambling, because the zone could always fail. We need confirmation, and there it is. On the 15-minute chart, a beautiful bullish engulfing candle forms right within our demand zone. This is our green light. This pattern occurs when a large green candle's body completely swallows the body of the previous red candle, It's a powerful signal that represents a dramatic and immediate shift in momentum. The sellers who were pushing the price down have been completely overwhelmed by a sudden surge of aggressive buying pressure. This isn't just a minor bounce, it's a clear statement of intent from the bulls, confirming that our 4-hour zone is being respected. With our confirmation locked in, we can now execute the trade. We enter a buy order at the close of that bullish engulfing candle. Next, and most importantly, is risk management. Our stop loss is placed strategically just a few pips below the absolute low of the 4-hour demand zone. This placement is logical. If the price breaks below this entire structure, our trade idea is invalidated, and we want to be taken out for a small controlled loss. Finally, where do we take our profit? We look left on the chart to identify the most recent significant swing high. This is a natural area where sellers previously stepped in and is a logical place for price to gravitate towards. By setting our target just below that high, we complete our trade plan. Let's look at the structure of this trade. The distance from our entry to our stop loss is our risk. The distance to our target is our potential reward. In this perfect scenario, it sets up a clean 1-to-3 risk to reward ratio. This means for every dollar we risk, we stand to make 3. This is the kind of asymmetrical bet that builds a trading account over the long term. Here are common mistakes traders make. Drawing zones too wide or too narrow, trading every zone without waiting for confirmation, ignoring the overall trend direction. Step 1, identify the zone. Step 2, wait for price to return. Step 3, confirm with lower timeframe price action. Step 4, place stop loss and take profit.